if I'm right about a credit event, if we are still in a bear market, probably some of these larger players starts to say, you know what, we need to diversify. So what do? Let's maybe go into gold. Let's up our gold allocation from nothing to 2%, 3%. Let's up our 3% allocation of 4 or 5 at the margin. Now, if you get enough big players doing that, that sparks, I think, a self-fulfilling momentum cycle. I would expect gold to do well in a flight to safety sequence, which we could be on the verge of, as spreads widen. And it then makes sense, right, for that momentum trade to really finally work after years of frustration.
Michael Gade, a popular financial services expert, metals analyst, and mutual fund portfolio manager, is certain that we are about to have a massive gold and silver price rally. Over the past few years, despite constant price rallies, gold prices have not seen a massive breakout in a long time, and investors are beginning to get really frustrated. Gold is generally viewed as a more stable, less volatile asset, especially when compared to metals like silver and copper, and other assets like cryptocurrencies. In addition, most gold investors are in it for the long haul. They understand that the current global financial system is on the edge of a massive collapse, and they trust that their gold and silver, for those invested in the cheaper metal, will serve as a permanent hedge against inflation. For many gold and silver investors, these assets also represent familiarity and stability in a world that is getting more and more unfamiliar and stable with every passing moment. We've not even mentioned the ever-growing risk of governments suddenly confiscating people's wealth to save whatever is left of the financial system when everything goes up in flames. So, most gold investors know they are in it for the long haul, and that while massive price increases will be great for their portfolios, it could be catastrophic for the global economy. But whether you want massive price increases or not, whether you are waiting for 300% gains or just holding onto your gold as insurance against a global catastrophe, experts believe it is all inevitable at this point. According to Michael, the United States economy is heading for a massive credit event that will have everyone, especially large institutional investors, scrambling for shelter in safe haven assets. Gold, an asset that has protected the interest and wealth of all categories of investors for thousands of years. When the rush begins, Michael is certain that we will finally get that massive price push most gold investors have been expecting for years. We will now bring you clips from Michael's recent interview with Commodity Culture. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and drop your comments and observations in the comment section below. Thanks, and enjoy the video.
If I'm right that we're still in a bear market, which again, I would challenge anybody on it just looking at very basic charts outside of the S&P and NASDAQ. If you start turning lower and spreads start to widen meaningfully here, which again, I think we're still very early on, but I think it has started. The bigger institutional players will probably say, you know what, maybe we need to diversify. Right? Now, from that perspective, there aren't that many real diversifiers from a portfolio construction perspective. Right? The S&P 500 is not diversified. The Russell 2000 is not diversified because they're still asset class specific, and they still largely correlate to each other, even though this year has been very abnormal in the disconnect of large to small. Now, gold is the ultimate non-correlated asset. By the way, not correlated to anything. All these narratives around gold is correlated to dollar, to stocks, to bonds, maybe in momentary rolling periods, but for the most part, gold doesn't really correlate to anything, which makes it a diversifier, right? Because the very idea of diversification is around correlation. So if I'm right about a credit event, if we are still in a bear market, probably some of these larger players starts to say, you know what, we need to diversify. So what do? Let's maybe go into gold. Let's up our gold allocation from nothing to 2%, 3%. Let's up our 3% allocation of 4 or 5 at the margin. Now, if you get enough big players doing that, that sparks, I think, a self-fulfilling momentum cycle. By the way, as gold is still not that far off from the prior peaks, if that ends up getting overtaken, which I think is possible, as a diversifier, gold does tend to also act like a risk-off safe haven trade for a moment in time. I would expect gold to do well in a flight to safety sequence, which we could be on the verge of, as spreads widen. And it then makes sense, right, for that momentum trade to really finally work after years of frustration. That's not so. Going back to your original question, would I consider buying gold or not? What I would say is I would consider gold working if people start thinking that correlation is not working, and I think we're getting close to that.
And explain if there's a correlation between lumber and gold that people should be paying attention to.
Okay, so it's deceptively simple. Lumber is a play on housing. Housing is a big driver of economic growth activity, credit expansion, risk on dynamics. Right? Lumber is highly correlated to housing starts. I am blown away how people don't really understand that. And yet they live in houses which would not be up there unless you had framing from lumber. Okay. Gold is, again, a risk-off safe haven. So you compare lumber's performance to gold's. Risk on being lower volatility dynamics for risk assets. Risk off being higher volatility dynamics for risk assets. Not based on my opinion, based on historical back-tested fact. Okay? Now, I have to tell you, this is another thing that drives me crazy. Lumber to gold is a signal. Now, where we are now is interesting. Home builders have turned around pretty aggressively. Right? There was a huge disconnect between lumber prices and lumber prices going down, and lumber price and home builder stocks rising. Right? But the fact that home builder stocks are weakening, and by the way, lumber to gold is also now weakening, suggesting risk off is imminent, right, is intriguing to me around the corporate credit event thesis. That you're getting some kind of confirmation in these two important parts of the marketplace. So bottom line is, it's not some magic relationship. There's a causation. Lumber is tied to housing. Gold is tied to risk-off safe haven behavior. You compare the two to each other. It tells you something about risk-on, risk-off volatility dynamics going forward. Not based on my opinion, based on fact. But if you're going to use it as a signal, you have to figure out which look-back period you want to look at to determine when to play offense and when to play defense.
During the interview, Michael also discusses one of the big elephants in the room, inflation, and what it means for the average American. According to the portfolio manager, inflation is the government's favorite tool of stealing from Americans. This is why whenever we get massive price increases due to their constant money printing, they blame everything but themselves and their ridiculous policies. Last year, we witnessed the President of the United States of America blame inflation on Putin, the Trump administration, China, UFO sightings, and everything else but what actually caused it: constant monetary printing, which is causing a very rapid debasement of the dollar. But the most terrible aspect of it all is that the constant money printing only favors our rich politicians and their buddies. For the average American household, it brings nothing but insane price increases, constant reduction in purchasing power, and stagnant wages. Michael captures the ridiculousness of the entire situation in a recent tweet which reads, "Unpopular opinion. Unrelenting government spending is disinflationary because corrupt politicians enrich themselves and their friends with those dollars, widening the wealth gap and crushing velocity of money. Few understand this."
So to be clear, I'm not like an anti-Fed type of personality, even though some people may think that based on reading posts like that. But I do think it's very clear that taxation is a form of theft. And by the way, it's a theft we agree to. I mean, it's part of the contract that we have with our governments, right? In response to using public transportation, using public works and services. So inflation is also a theft to the extent that the powers that be want to concentrate power further. What do? They basically create policies that inherently only benefit a select number of individuals and institutions. Inflation rises as that occurs. The net value of most people's assets going down after inflation, whether it's an actual piece of property or it's an income stream, whatever it would be. The whole point of that post is it's just kind of comical to me that you have this narrative, which, by the way, is valid, that there's no real property rights in China because they can do whatever they want and take it away. Meanwhile, by the way, you have eminent domain in the U.S. And you have policies which clearly have been inflationary, benefiting, again, a select number of people, and everyone else getting screwed by the inflation that comes with it, which it does erode their property. So just because you don't have a government that's outright physically taking what you own that's worth something, and instead is inflation eroding that away, doesn't mean they're not still taking it. I think that's sort of the point. Now, what do you do about it is a whole other dynamic. I mean, the reality is everyone's forced to take risk. And the problem, of course, there is that if you're forced to take risk, you might be able to counter the effects of the government taking your assets through inflation. You also might lose more. I think they could be forced to pivot if you have a very sharp credit spread widening type of dynamic, which is a VIX spike, which is a crash. Doesn't have to play out exactly like 1987, but typically, there's a reason why there's that expression of staircase up, elevator down, right? And if I'm right that we're in the credit event, and phase 2 of the credit event is the corporate credit event, and that starts with this widening that's happening at the margin, it can get out of control very quickly. If it gets out of control very quickly, the Fed, I don't think, would actually pivot necessarily in terms of rates. They might pivot first in terms of the balance sheet, right? Because I do think that even if you have a massive sudden dislocation, whether it's sparked by Japan or China or something domestically here in the US, either way, they don't want to be seen as being whipsawed around short rates, but they can certainly still play with the balance sheet. You know, a little caveat, I think, on that end. But what it does in terms of acting with a lag, also, meaning they respond to a crisis after the crisis. So it's not that I'm trying to be a perma bear by any means. I mean, anybody that's looked at my research and my work sees that I'm clearly not wedded to any particular longer term viewpoint. But history would suggest that if you have a credit event, the Fed steps in. They'll step in too late. The credit event and the pain would still have taken place. But yeah, to think that the Fed can't pivot just because we're this late in the year, it happened in 1987. What's to say it can't happen again?
Michael is predicting a massive credit event which will instantly cause a Fed pivot. We saw the first whispers of that impending crisis during the U.S. regional banking sector crisis in March and April. The Fed's immediate response was to swing to the rescue, and that's exactly what will happen again and again every time we come close to a serious crisis. But for how long can they keep this up? When will they finally realize that further monetary printing will only send us deeper into the debt spiral and worsen the situation? The good news here is that a Fed pivot will be insanely huge for precious metals like gold and silver. Depending on the scale in which it occurs, we could even see silver smash its previous all-time high to establish a new one. Do you think that is a possibility if the Fed starts printing again today? Do you think we will see significant increases in the prices of gold, silver, and other metals in 2024? Please drop your comments in the comments section below. Also, ensure you subscribe to the channel, turn on post notifications for more videos on gold, silver, and copper. Thanks for watching.